you. My name is Kaylee White. These are my teammates, Aiden Meekin, Taylor Finch, Matt Flowers, and Josh Stevens. We represent Hardin University of Searcy, Arkansas. Our presentation this morning has two parts. We will begin by analyzing qualitative factors about Chicago Bridge & Iron, stock symbol CBI, before we shift our focus to our analysis of the company's financial statements and company stock. The first thing we notice about Chicago Bridge & Iron is its misleading name. It is neither headquartered in Chicago, and it does not build bridges. Rather, the company provides engineering, procurement, and construction services to the energy industry. CBI is currently comprised of three segments: project engineering and construction, steel-based structures, and Lewis Technology. The diversity of these three segments allows the company to complete substantial projects, what they call concept to completion. Management strategy is working. Last year, revenues increased by nearly 24%, and the company's profit margins are leading the industry. Looking forward into 2013, management has identified three key initiatives to promote growth: the acquisition of Shaw Group, expanded market share in the liquefied natural gas or LNG industry, as well as debt management. In line with the points I've just made, and complemented by our analysis of the company's stock, we have identified a target price of $79.44 and recommended buy CBI stock at $68.80 or below.
CBI is in the engineering, procurement, and construction industry, EPC for short. EPC companies design and fabricate facilities that store and refine oil and natural gas products. These projects are large in size and global in nature. Currently, there are three major trends driving the EPC market. The first is the movement towards hydraulic fracturing. This technology has monumentally increased access to natural gas deposits. Consequently, demand for LNG is expected to increase 16% in the U.S. over the next 12 months and 50% internationally over the next 5 years. The second key market driver is the continued industrialization of India and China. The World Bank forecasts a global economic growth rate of 2.4% in 2013 and 3.1% in 2014. The UN predicts that India and China will expand at a much faster rate of 6.1% and over 8% respectively. With a combined population of over 2 billion and with relatively low energy consumption rates, it's almost a certainty that demand for energy in India and China will be robust for many years. The third key market driver is the global focus on climate change. The industry has already seen revenues from increased activity in alternative energy. We believe CBI is well positioned to take advantage of these industry trends. For the first reason, CBI is an industry leader when it comes to LNG. They were the first company to develop and fabricate LNG storage containers. Secondly, CBI has significant market share in fast-growing international markets. The company owns over 30 facilities in 17 countries, including India and China. Lastly, management has added scale and services so that CBI can successfully pursue its strategy of concept to completion. With the acquisition of Shaw, it's emblematic of their business plan and will significantly magnify their services, capacity, location, personnel backlog, and cash flows of CBI.
CBI's key risk factors can be divided into two categories: internal and external. The first internal risk is the pending acquisition of the Shaw Group. Although we anticipate a very successful merger, if this acquisition is not completed, this could have a negative impact on CBI's stock price. The second internal risk factor is the impending 200% increase in backlog, as CBI may be unable to fulfill the terms of each project or customers may back out of those contracts. The third internal risk is CBI's sensitivity to contracting terms. Management is working to reduce these risks by engaging in more cost reimbursement contracts rather than fixed or hybrid contracts. The fourth and final internal risk is cash flow management due to the awarding, timing, cancellation, delay, or reimbursement of contracts. The key external factor is industry activity. CBI's future revenues would be negatively impacted by a reduction in the level of activity in the hydrocarbon industry. Factors like global environmental, political, and economic factors are negatively affected if all these factors are negatively affected. Despite all these risks, we are very confident about CBI's future, as we believe the positives of this company far outweigh their risks.
Financial statements support and reflect the company's growth in many ways. We predict that in 2012, the revenues will reach $5.4 billion. This would continue a growth rate of 18% year over year since 2007. We predict that in 2013, following the Shaw acquisition, revenues will reach as high as $12.6 billion. The gross profit margin has expanded from 8.2 to 12.8% a year over the last 5 years. Over that same time period, operating profit margin has grown 11.9% annually. The net profit margin we predict will reach 5.8% following the Shaw acquisition. This would represent CBI's highest net profit margin in over a decade. On the balance sheet, we see liquidity improving. The current ratio has grown from 0.6 to 1.06. Accounts receivable turnover has accelerated from 7.8 to 10.6 times a year. We attribute this acceleration to management's ability to enhance their company's cash flows. We expect to see return on equity expand materially as a result of the Shaw acquisition. The addition of $2.2 billion in liabilities will expand their ratios and their overall balance sheet. However, even with this addition of liabilities, we expect them to manage debt to equity well, keep it low. Finally, on the cash flow statement, we see that they are well positioned for the Shaw acquisition. In addition to collecting receivables more quickly, they have also increased their payables and allowed capital expenditures to decrease. Using this additional cash flow, they have built their treasury stock, and they will use this to participate in a stock swap with Shaw.
To determine a point target estimate for CBI, we employed several valuation methods. This included discounted cash flow, enterprise value EBITDA, price multiples, and the dividend discount model. The result of our analysis is a target price of $79.44. For discounted cash flows, we created a multi-stage growth rate model that forecasts future cash flow for each company. For the first year's growth rate, we calculated a 10-year CAGR of CBI's free cash flow of 18.74%. We then decreased this rate each year until we arrived at our terminal value of 2.5%. This reduction is due to the large size of the companies post-acquisition. Our terminal growth rate of 2.5% is a conservative estimate of long-term global GDP growth. This analysis resulted in a likely price of $76.41. To test the sensitivity of this analysis, we varied the terminal growth rate by plus or minus 0.5%. This generated a price range of $73 to $80. We then varied the weighted average cost of capital by plus or minus 1 percentage point. This generated a price range of $65 to $92. The weighted average cost of capital we calculated has two components. It's the capital asset pricing model that calculated the cost of equity. The variables included in our CAPM were the 10-year U.S. Treasury rate of 1.84%, an expected market return of 9%, and a weighted average beta of 1.93. We calculated a 5-year beta for each company and then took a weighted average of these betas based on each company's respective market cap. We calculated the cost of equity to be 15.56%. We then calculated the after-tax cost of debt to be 4.17%. As I mentioned earlier, we did an enterprise value EBITDA valuation. We calculated a 10-year trailing multiple for CBI and a 5-year multiple for Shaw. We then took a weighted average of these multiples based on each company's market cap. This generated a likely price of 85 to 85 after we paired it with our projected 2013 EBITDA of the combined companies. To test the sensitivity of this analysis, we varied the multiple by plus or minus 2 times. This generated a price range from $79 to $97. Finally, we did price multiple analysis over 10 years of history. We used a line of best fit to eliminate outliers, then we selected high, low, and likely stock prices based on these multiples. We paired these multiples. We then took a weighted average of these multiples and came up with a likely price of $76.92. To test the sensitivity of the PE multiple, we varied the multiple in earnings per share to generate a price range of $70 to $99. We also did a dividend discount model, but the results were not meaningful or reliable. After weighing each of our analysis, we came up with a target price of $79.44.
In conclusion, we're confident that our financial forecasts and analyses are backed by reasonable assumptions and accepted methods. Therefore, we are confident that in the 12-month price target of $79.44 and strongly recommended by CBI stock at $68.80 or below. This concludes our prepared remarks. Thank you for your time and attention. We'll now answer your questions.
So where are the shares currently trading as of yesterday?
The closing price? Yes. The market closed at $51.25.
When we began this competition, they were in the 30s, so it's already increased the price since last time.
Do you think that the price will change considering that CBI would pay for the acquisition of Shaw through treasury stock, as you mentioned, and issuing the new shares? What do you think will be the impact?
the impact on the price based on the acquisition. All these valuations that we have done include Shaw as well. We also did valuations for CBI alone. We got a target price of $62.07. For each of these analysis, we have incorporated the new debt coming in, the treasury side. We have incorporated all that into these analysis with the combined companies together.
So I mean, Shaw is the only mature company around a while. It's a big company, right? So if there is 60% upside to the current share price, that means the market is massively mispriced shares on the company. So how do you explain that?
Well, I'll start off, from a macro perspective, the EPC industry as a whole is very speculative, and especially with two companies of this size and stature merging as one, there's always going to be speculation leading into it from a qualitative perspective. We perceive that following the acquisition, which within the current following months, that there'll be a drastic spike once the synergies have come together. Our financial analysis of this proves that over the next 12 months, it'll jump drastically.
Additionally, as you were saying, it's a very speculative market. We also have considered that we have been very conservative in our estimates and our projections. It is possible for it to go higher even. We tried to do our best to maintain a conservative outlook so that we don't seem to be that far ahead compared. They've moved about as much from the time we started to now as we project they will in the next 12 months. And that's largely a result of our conservatism in estimates and assumptions.
Does CBI have a services component to its revenue? Or is it just project and then move on?
You mean continuing services?
Yes.
Well, it's largely a project-based industry. But they offer services the entire way through, from drafting at the beginning all the way through the actual construction of the project.
Loomis Technology, it mainly focuses on the patents and the licensing and the science behind the refining and whatnot. And then steel plate structures manufactures the steel plates, which are then built through the project engineering and construction segment of the company. So they have a great concept to completion marketing strategy, and they're not actually involved in the offshore drilling. They just build rigs for the offshore drilling.
What about the continued maintenance of the plants they build and those types of services rather than the offshore drilling environment?
I think, mostly within the three segments of the business, Loomis Technology really has the service arm of the business, and they kind of facilitate the process all the way through, from the beginning, drafting, like you said, all the way to the end. And then there's, patenting and licensing, which follows up through the whole process and maintains the high quality of service of the projects that they provide. So yes, that's the service hand of it, and they do follow up to make sure all the technology is moving correctly within those projects that they create.
As far as long-term service, other than standing in an advisory role, I don't know that they have. I haven't seen any inclination that they have continued relationships except for newly created projects.
So if you have an industrial company, which I've classified this as an industrial sector, and if you get to a PE multiple about 18, which is what your price target is roughly, without a services component on a 6% growth rate or something like that, there's a disconnect there. How do you?
I believe with the 200% increase in backlog, they have years and years of work coming their way, which I think can affect our financial forecast for the next, at least 5 years. That's what the company has told us in the conference call that we had at the beginning. And just this backlog that they're also gaining, because it's tripling with the size of shops. So with the combined backlogs, they have work coming their way for the next few years.
Basically, what kind of backlog are we looking at? How is it right now? But if it's nuclear, are they actually going to go through and do the nuclear plants? Do you think?
The majority of their backlog is actually LNG projects. About 35 to 40% is the LNG projects, and I believe that they're saving most of their backlog for those projects because that's where money's coming in, is into into alternative energy research and stuff.
What portion is related to global activities and the markets in Asia, the background?
I'm not certain about exactly, like they broke it down for us. LNG, different petrochemical, but LNG was the biggest chunk, and then there's some petrochemical and hydrocarbon stuff.
I'm not sure if there's an exact number of percent backlog broken out by country, but obviously in expanding markets, there's already backlog and then current projects coming to CBI.
Many years ago, they used to classify revenues by geographic location, so it was a little easier to track such a thing. Since about 2006, they have actually been recording more based on the industry arms, the different segments of their business rather than geographic location.
So in your calculation, you show equity value of 2.7 billion. The market cap of the standalone enterprise, CPI, should be around 5 billion, because if you have $50 per share times 105 million share, that's about 5 billion. And then the combined entity, you show an equity market value of 9 billion. So that's quite a discount. Sure. It's the right calculation.
Whenever we did the weighted average cost of capital, you're talking about well, we had this calculation right here?
Yeah.
Okay. Well, we took the equity of the two companies and came up, this is the equity that we projected on their balance sheet. And then we added in the debt from the merger. So that's where the difference came from. Is that what you're asking?
Mm-hmm.
And then we did the weighted average for each and to come up with our weighted average cost.
So what equity market risk premium are you using to calculate the cost of equity?
We assumed a 9% expected market return and 1.84% 10-year U.S. Treasury.
Kind of piggybacking on his point, I mean, you have a combined beta, and I'm just kind of roughing it up, what's called 1.718. You know, for a fairly mature business, you usually see in that meeting to a PE or a price target of 18. You don't usually see betas, high betas, mature market, and high PEs together. So square that circle.
Well, I think the reason we're seeing such a high beta here is just people are unsure of how fast the LNG market's going to grow, and they're so exposed to these different markets that they, historically, they have traded up or down more than the S&P 500 as a total. So I think that the beta, CBI's beta was quite a bit higher than Shaw's. But coming together, we believe that 1.93 is a reasonable estimate of their beta.
Additionally, as Taylor mentioned in the presentation, there are several risk factors affecting CBI, and it is such a global company that any economic, political, or environmental concerns could affect their business. Currently, the economy of Europe may be concerned. There's concern here regarding liquefied natural gas to some extent. So all of these factors combined makes it a volatile company just in the market.
I think that also goes back to your point about them not really being a service industry, but rather a project industry.
I guess we ran out of questions.
Okay, there you go.
Perfect.